Welcome to the second segment of our long discussion on this fascinating report on emerging markets produced by the London Business School academics Elroy Dimson, Paul Marsh and Mike Staunton. Today what I'm hoping to do is to talk through exactly how it is best to try to trade within emerging markets and how their behaviour differs from those of developed markets. Now with me now to discuss this is one of the authors, Elroy Dimson. Elroy, thanks for joining me once more. What we're going to talk about now are the three critical effects which your research in developed markets have shown persist in markets over time. These are the premiums for size, for value, and for momentum. Let's start by taking a look at the size premium or the size effect in emerging markets. Take me through what you understand by the size effect and how it differs in emerging markets compared to developed markets.
First of all, we use the language very carefully. What we mean by size effect is a difference in performance between small caps and large caps.
Right.
We expect that to continue in many markets and forever. The size premium is the historical record of small companies having beaten large companies. And in the chart that we are looking at over here, you can see for a number of emerging markets what their size premium was, sometimes unfavorable and more often favorable. That's
Right.
in red. And in blue, you can see a comparison between the situation for emerging markets as a whole and developed markets.
Okay, so there is a much smaller size effect. There's a much smaller advantage in performance for smaller companies in emerging markets as a whole than there is in most developed markets.
Yes, in developed markets for the periods that we're looking at here, which is the data for this century so far, people who invested in smaller companies in developed markets were well rewarded for it. There was a rather modest reward, maybe barely even worth the trouble in emerging markets.
Okay, so do we have any theories as to why that might be? I mean, many emerging markets are dominated by a few large companies. Is it because emerging markets are full of large oligopolies, or why would this effect be so different?
Well, when we see a small firm effect that's positive, what that represents is small companies doing better than large companies.
Right.
I can't give you the full answer. One conjecture is that large companies in emerging markets actually did rather well as they reached out
Right.
to do business with the globe, and so small companies would have struggled to beat that.
Right. Now let's take a look at the value effect. This is the tendency for cheaper companies at the time that they're bought to outperform more expensive companies, I think using dividend yield in this case.
Yes.
Take me through the pattern that we see here.
Well, here you can see the different patterns for each market, but on balance, these emerging markets have had a very favorable value effect. Buying cheap companies compared to expensive companies has done rather well. And there's a comparison on the right, which is the blue bars,
Yes.
where we look at emerging compared to developed markets, and here the value effect, the benefits of buying companies that are cheap in relation to their fundamentals, has clearly paid off.
So do you actually have any conjecture as to why there might even be a slightly stronger value effect in emerging markets than elsewhere? I mean, are there big buying opportunities when crises come around?
Well, we've looked at a period in which emerging markets have gone up and down, but they're still around.
Right.
And buying somewhat distressed companies that sell at a relatively low price has been rewarded with hindsight. I dare say if emerging markets had disappeared by the time we reached the end of this period, then we'd see a different story.
Okay, and now the final great effect that's been identified by your research and others is the momentum effect for winners to keep winning, or at least to keep doing relatively better than losers. And again, this shows a much more varied picture, but take us through what do you think the effect of momentum investing in emerging markets is?
Well, we've ranked this by the longest possible period for which data is available for these markets. That's in blue.
Right.
The data consists partly of our analysis and partly of early analysis by other authors. On the right-hand side, you can see that there's still a rather substantial reward.
Yes.
It may look as though it's only 0.5 to 1, but these are percent per month excess returns of
really?
winners compared to losers. So there has still been a substantial gain from pursuing past winners.
Okay, but it's still somewhat more muted than in developed markets.
Yes, that's true. It's smaller, but developed markets are on the upside compared to 0.5% a month. Emerging markets are below, so they're perhaps of the order of 0.25% per month.
Right.
This is still a big level of outperformance.
So one final brief encapsulation then. When it comes to investing in emerging markets, the same rules do apply as in developed markets, but the value effect is much stronger and the other effects are a bit weaker. Is that a fair summation?
That sums up the 21st century so far.
Great. Elroy, thank you very much indeed. In conclusion, emerging markets are still emerging, they're still changing, but the basic rules still apply. The cheaper you can buy something, the better the chances are in the long run that it will pay off for you.